Kitco Mining special coverage of the Mining Forum Americas is brought to you by Metalla Royalty and Streaming.
Our funds flowing back into gold equities. Hello and welcome to Kitco Mining with me, Paul Harris, at the 2025 Mining Forum Americas here in Colorado Springs. Joining me today is our sponsor, Brett Heath, CEO of Metalla Royalty and Streaming. Brett, welcome back to Kitco.
Thanks for having me.
It's an exciting time in the precious metal space. Gold at $3,600 per ounce, silver at over $42 per ounce, copper as well, let's bring that in, why not, at $4.50 a pound. What is happening in the gold space, Brett, and what is happening with fund flows?
Yeah, well, it's interesting because what we've seen gold really shift from a hedge or insurance to, I think, the de facto or in process to be the de facto reserve asset. What we've seen in the first time in the last 30 years is gold as a percentage of global reserves has just surpassed U.S. Treasuries. And this is a long-term trend that's been in place. But what it tells you is that we're really just in the middle of this transition. You still have central banks that hold, $4.5 billion or so of U.S. Treasuries, or upward almost foreign central banks, almost $9 billion of U.S. Treasuries, and so we're continuing to see more fund flows coming into gold, coming into physical, and obviously now that's finally having a pretty material effect on the mining stocks.
I think one of the interesting things about central bank buying is, the reason they're buying it means they're effectively price inelastic. They're not looking at the ups and downs of the gold price and timing it for that reason. They want the gold for a different reason.
They do, and it's a sensible thing that these central banks are doing. Also, big sovereign wealth funds and other institutions around the world, they're holding these U.S. Treasuries. These U.S. Treasuries have been kind of the tier one global reserve asset. They're slowly losing that reserve status, and as that changes, there's really one market that can kind of fill that void. And you look at kind of what's happening here, like that's gold. So what does that tell you? Like, where does gold really need to be the global reserve asset? And in my opinion, I think gold needs to rise up to about 50% of global reserves. Currently, it's kind of in the mid-20 range. So what that tells me is we could see gold move, significantly higher from this perspective, from where it's priced at today.
Now, we're at an investment event, and so we're obviously very much focused on gold stocks here. The GDX has hit highs, but it continues to experience outflows. What's going on there?
It's a bit of an anomaly, something that we've never witnessed before in previous bull markets within the gold sector over the last really 20, 30 years. But what we've seen in the gold sector is as these stocks in these gold indexes and so forth have performed extraordinarily well. A lot of them are up upwards of 100% this year already, far outpacing all other asset classes, including gold itself. Yet we still continue to see outflows. What that tells me is that we still have not seen kind of the material shift of generalists coming into this sector. It also tells me that the gold price can still probably move a lot higher as it starts to pull in, as all of these other institutions around the world that maybe hold U.S. Treasuries as a reserve asset for collateral purposes and so forth, all of these banks and so forth, as they start to transition, into gold, it's just going to propel it even higher.
As you mentioned, Brett, we've seen some stocks with 100% gains year to date or over, year on year. The laggards, 50% gains, and people are complaining they've only made 50% gains. Are we getting into a crazy screaming bull market?
Oh, well, we're in a bull market. Again, it's interesting to see such stellar performance amongst the mining equities. A lot of it just within the last month or two. We just started to see some capital flows into, call it the sub-billion market cap part of the market just in the last month. So there's a lot of really great opportunities, and these stocks have not experienced the big gains. Like as gold started moving, gold was the first thing to move. Kind of slowly select large cap royalty companies and large cap mining companies started to move, and that kind of has filtered its way down. And now we're seeing, the smaller kind of junior market cap type companies start to make significant moves, but not small ones, right? You're seeing 20, 30, 40% in a week or 2 weeks or 3 weeks, like very substantial moves. My expectation is that this is the beginning of the trend. And I think that the junior part of the market is really in this kind of almost like float up phase where it has to catch up to the performance of gold. It has to catch up relative to the performance of the majors. And even when you look at the big indexes priced in gold, they still have a long ways to go. So I think right now there are incredible asymmetric opportunities, particularly in the junior side of the sector.
It does seem odd, given that context, Brett, that when you look at the investors and speaking with people here at this event and last week at the Precious Metal Summit, it still seems to be, in the gold stocks at least, it still seems to be a private club of resource investors. Despite the 100% gains, the generalist investors are still not really showing up, which seems weird because you'd have thought with 100% gains, be like moss to a lamp.
Mm-hmm. It's you would expect that, and again, I think this is all very bullish for the sector. If there were generalists all over this conference, and you would see that type of activity, that would probably make me a lot more nervous. But when I look at the institutions that are here, these are institutions that have been in and around this sector for decades. So it does show you that, really, there is not that type of demand yet. We're seeing the performance of these stocks, despite the lack of inflows, and not even inflows, but outflows. So what happens when there actually are material inflows coming into the sector, and really what does that do to the performance of these equities? I think that what we have right now is we have a sector that is experiencing the highest margin across the industry with all the mining companies that it's had in the last 15, 20 years.
We were talking about this earlier this morning, weren't we? How margins have rocketed up. The better producers have got 50, 60, even 70% margins now. And I think you said to me that the historical average is somewhere around 30%.
Yeah, so what typically happens is the gold price comes up and costs go with it, or the gold price goes down, costs go with it. And so if you go back, I looked at data all the way back to 2009. And when you look at that data, the ASIC margin to gold price since 2009 has really averaged around 30%, 31, maybe 32%. When you look at it where it is today, it's like 60% plus. So these are fantastic margins. Yet when you look at kind of the backdrop of the industry, you're not really seeing kind of that cost curve come into it yet. I think that there probably will be some costs that creep into it, but when you look at the last 15 years, these are big, solid margins that I don't believe that the generalists are going to be able to ignore for much longer.
So if we're here next year and it's standing room only, that'll perhaps be top of the market.
Well, look, one of the hardest things as someone that's been in and around this industry for decades is really being able to kind of hold on to those gains. And when you get these structural shifts, meaning that right now we're in the middle of this structural shift of gold playing a very significant or different, more meaningful role within the financial system. And when you think about that, you think about the implications of what that really means to this business, what that means to companies like Metalla, that has 1.6 million ounces of gold equivalent ounces to our account in the ground, operated by a lot of major mining companies and big mid-tiers. It's going to be difficult to hold on to those gains. But I think that when you look at the backdrop or the macro backdrop, this is a structural shift. So I think likely we're going to see probably, now it doesn't mean there's not going to be sharp corrections along the way, but I think this is something that we see play out through the end of this decade.
Okay, let's bring our conversation specific to the royalty and streaming space, where since we sat here a year ago, Brett, there have been some dramatic changes in the space. In April, Triple Flag bought Origin in a $421 million Canadian deal to get a royalty in Anglo Ashanti's Arthur project. Then Franco-Nevada bought a 1% NSR on the same project. Then in July, Royal Gold announced it will acquire Sandstorm Gold royalties, $3.5 billion deal. And most recently of all, Elemental Altus Royalties is merging with EMX Royalty to create a $1 billion mid-tier company, which will actually leapfrog over you guys in terms of its market capitalization. Earlier stablecoin company Tether bought into Elemental Altus Royalties. What's going on in the royalty space, Brett?
Well, I think what we're seeing is really kind of a symptom of really the opportunity set. So from January 2024 till today, the big three royalty companies by themselves has had a market cap increase of about $30 billion in about 18 months. To put that in perspective, the whole entire royalty industry took about 20, 30 years to get to about $30 billion of market cap. So these companies are now kicking off enormous amounts of free cash. In fact, the big three royalty companies combined are expected to kick off somewhere around four and a half, maybe upwards of $5 billion just this year. Analysts have estimated. And so how do you redeploy that capital? And I guess as an extension of that, kind of where is the market kind of prioritizing allocating this capital? And I think what is in common across all of those different things that you just mentioned is the market is really focusing on higher quality, longer term, tier one type of assets. And there's very, very few of those that are out there. Metalla has a bunch in our portfolio, but you can't find them everywhere. So you see companies start to look and start to prioritize maybe M&A in order to get access to these types of assets. So when you look at the triple fag origin, they were able to pick up a tier one, very, very high quality, very, very multi-decade exposure type of gold asset, will be kind of a prominent gold camp in Nevada for probably the next 30, 40 plus years. And companies are willing to kind of do other things to get exposure to these high quality assets. And I think you're seeing that across the board when you look at, just on the smaller end, like with Tether coming into the industry, I think you do see some kind of resemblance again, like they're looking to get exposure to high quality reserves in the ground.
Now, it's interesting what you mentioned there because Franco-Nevada and Wheaton Precious Metals, they now have higher market capitalizations than Barrick Mining, which make them the third and fourth largest precious metals companies if you view them through that optic. Which brings me to a good question. Scale is paramount in this sector, more so than perhaps any other subsector of the mining space, because big scale means you have the lowest cost of capital, which means you can outprice anybody for the best deals. That's obviously the advantage Franco have and Wheaton. What pressure does that put on you as a CEO to scale up?
Well, scale is critical in this industry. In order to grow your business, you have to have access to a reasonable cost of capital and access to that. Metalla recently put in place a credit facility with Bank of Montreal and National Bank Financial. So we've got about a $75 million US facility that's in place today. We have very little, a few $1 million of basically net debt on the balance sheet. So we have the firepower today to be able to go look at bigger types of transactions. I mean, one of the competitive advantages that Metalla has had over its existence is the ability to kind of source and execute these transactions outside of kind of more competitive environments. As you go kind of further up the curve in higher profile assets, those are much more difficult to keep out of competitive type processes. But I think I'm confident that Metalla will be able to execute on one of these transactions and scale our business kind of accordingly.
What's the sort of bandwidth of transaction that you can embrace?
Well, in the early days, over the first 8 years of Metalla's existence, we were doing 4 to 6 transactions a year. We don't really expect that anymore. We're looking at much more meaningful transactions and maybe, 1 a year, 2 a year type of opportunities. I think that's a sensible way to kind of deploy capital, be able to utilize credit as a way to grow, reduce dilution, focus really on producing assets or near-term producing assets that'll allow us to kind of de-lever that credit that's used and reload and kind of grow the kind of traditional way as a mid-tier.
And what kind of deal size can you sort of contemplate? 50 million, 100 million, 200 million?
I mean, it's really just a function of what that asset will support. I mean, currently our credit facility is up to 75 million US. Obviously, there's on a really good acquisition, like there could be an equity component as well to that. But it's really what that asset supports. And so, I think that we can be kind of reasonably competitive. We have access to that capital to be able to grow our business and scale. So we're excited to do that.
With the gold, silver and copper prices flying high, what does that do for potential deal flow? Because higher prices means that the companies, the miners, the developers have other access to other types of finance. If you're a producer, you may not need finance. You may be able to fund things more through your own cash flow. What does that do for deal flow?
Well, it means that you typically need to be a bit more creative. So you need to kind of think a little bit more outside the box. You need to think about different types of structures. If you look at kind of the majors, the way that they're approaching it, like you've seen transactions where they're not just providing the royalty in the stream, they're providing equity and debt and kind of a combination thereof. I think there's different ways that we're looking at approaching, business development, and I think it's not going to be the type of market where you kind of sit back, and you wait for something to come up for sale and you try to bid on it. I don't think that's a very effective way to grow the business in this environment, given how competitive it is. So you're going to have to do a little bit more work. You're going to have to roll up your sleeves. But again, that's what Metalla has really had a competitive advantage on since the beginning.
I think we've seen that in one of the transactions that was announced this week. Barrick Mining selling its Hemlo operation, and within that transaction, Wheaton Precious Metals was, let's say, a kingmaker because it's provided $400 million towards that $1 billion purchase price, and that perhaps paved the way to Orion Mine Finance loaning or lending $400 million to that. Will we see more of that kind of kingmaker action?
I think so. I think that the royalty sector is going to have to get a bit more dynamic in the way that they look at being a capital provider to this sector. I think that it's going to be a bit more entrepreneurial. I think it's going to be more kind of a partnership type of structure with a lot of the operators. I still think there's lots of M&A that's likely going to happen within the mining sector, and ultimately that creates more opportunities as smaller assets become non-core, and other companies want to come in and acquire those, and we'll need funding and financing for them. So there's always ways to grow. I would say that there's actually kind of a lot happening across the sector right now. Everyone that I have kind of been speaking to has been fairly kind of busy looking at a number of different things. So there still are a lot of opportunities. I would just say that the really high quality ones are, those for sure are driving big premiums.
I imagine as the metals prices increase, getting enthusiasm for deal ideas becomes perhaps a little bit easier to get people behind them and say, let's put this company in that company, get a great idea, let's go for it.
Well, it's one of those things because now there's lots of funding, there's lots of capital. Like that's less of a concern in this market, is being able to raise the money that you need for, if it's a good high quality asset and a good operator in a good jurisdiction. That's the fairly easy part of the equation. The more difficult is finding it, and the other difficult part is being able to kind of bid against a sector that has a very low cost of capital, like relatively to the rest of the market. What is a benefit, or the advantage that Metalla has, kind of where we've positioned ourselves over the long term, is that we have a very significant amount of organic growth already bought and paid for within the portfolio. So we've got 100 royalties. You got 88% of the value of our portfolio in development. That means a lot of organic growth. So we expect about a 30 to 35% CAGR in revenue growth or gold equivalent growth between now and the end of the decade. This is all bought and paid for growth. And so what that allows us to do is that allows us to be able to maintain our discipline in these types of environments where if you don't have that organic growth built into your portfolio, then typically you're a bit more motivated to deploy that capital to make sure that you don't kind of have negative growth in the future.
With that kind of growth, Brett, are you looking over your shoulder? Because I imagine a number of companies are eyeing you about we'd love that kind of growth in our portfolio.
Well, we're really excited about the opportunity in the business. Obviously, as there's more consolidation, that equals more opportunity. We think that there's a big potential void within the mid-tier part of the market that Metalla is very, very well positioned to fill. And so the focus that we have right now is just keeping our heads down, building that kind of momentum within the corporate development pipeline and going out and executing in an accretive fashion, just like we have over the last 32 transactions that we made, just probably larger type of deal and probably producing would be kind of the way that we look at it right now.
Well, let's have a quite a dynamic question to end with, Brett. We've just seen a mega merger announced in the copper space. It's been a good 5 or 6 years since there was a mega merger in the gold space. Is it about time for another gold mega merger? Is that necessary?
You know, that's a good question. I mean, I think ultimately we saw a handful of very large gold mega mergers. I think where you're probably going to see the most action, and again, this is a common theme, not just within the royalty sector, but also I think it is extended to the mining sector, is you're going to see these larger companies really take a deeper look at the high quality assets that are already built or heavily advanced on their way to production. There's not a lot of these that are out there that exist. A lot of them have been consolidated prior. So, I think where investors are going to find the most value today is really in the really high quality reserves, high quality projects in good jurisdictions, and maybe ones that are a little bit off the radar. As we noted earlier, like high profile big companies, they made a great move. They're trading at very kind of not attractive, but a very kind of high valuations. But that capital is now shifting. We mentioned the GDX has had outflows, and I just looked this last month on what the flows were. We saw $330 million of outflows in the GDX in the last 30 days. Now that was on the backdrop of gold basically breaking out of its short-term consolidation, marching its way to all-time highs. But when I look at the GDX, over that same period, it had about $180 million of inflows, which is pretty interesting because I haven't seen that type of activity in the last 3 years, really. Like, it's really been driven by the larger companies. And I think, the key takeaway now is that it's time to really look at the smaller part of the market. And again, I don't think it's going to be a rising tide lifting all boat type of situation. Just as when you looked at the major companies that really outperformed, I think it's going to be the higher quality juniors with really great assets that were kind of overlooked or really kind of bypassed just generally because of where the market was. And I think those are going to perform extraordinarily well over this next phase of this bull market.
Okay. Brett, let's end with what are some of the catalysts our viewers can expect to see from Metalla over the next 6 to 12 months or so?
So a big catalyst for us today is the Endeavor royalty that we have. Just started production. We're expecting our first royalty payment in Q3 of this year.
Endeavor Silver, Endeavor Mining.
This is the Endeavor mine. It's a silver lead zinc mine in Australia. We have a 4% royalty on it. We also have another asset coming into production called Amalgamated Kirkland. This is an Agnico Eagle asset in Canada. That's expected to start production in Q4 of this year. And then as we get into 2026, we've got some really significant catalysts on our development assets. One, Castle Mountain is expected to get their permit. Equinox has got that project in the Fast 41 program on permitting, which is a new program that Trump put in place to kind of fast track projects into production. So we're expecting a permit on that asset by the end of December. That's going to set up Equinox to basically be able to put a construction decision and financing package around that. The integration of Gosselin into Côté, also huge catalyst for us. Gosselin and Côté has had about 100,000 meters of drilling that has not been included in a resource update for almost 2 years. So we're expecting a significant jump in reserves and resources, particularly on Gosselin, where our royalty covers 100% of it. Now, this is a mine that's in production today. It's being scaled up. It's soon going to be the third largest gold mine in Canada. And the integration of Gosselin is going to daylight a lot of value of where our royalty is, what it covers, and really make it a lot real, I think, for our investors. So that's another very significant catalyst that I think is likely going to happen within the next 12 months.
Well, it sounds like you've got a lot of exciting things. Brett, Heath, our sponsor, thank you very much for joining us today.
Yes, thanks, Paul.
And we have a lot more to come from the 2025 Mining Forum Americas conference here in Colorado Springs, so hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining special coverage of the Mining Forum Americas is brought to you by Metalla Royalty and Streaming.